Subcommittee on Housing and Insurance will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is entitled "The Current Mortgage Market, Undermining Housing Affordability with Politics." Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. Today's hearing is entitled "The Current Mortgage Market, Undermining Housing Affordability with Politics." We will receive testimony from experts in the housing industry to discuss recent actions taken by the Federal Housing Finance Agency. Housing affordability is crucial to giving Americans the opportunity to build wealth through home ownership. Home ownership, in turn, paves the way for success in many other aspects of life. In essence, housing affordability is a cornerstone for pursuing the American dream. The importance of maintaining a fair and undistorted mortgage market cannot be understated. Currently, residential consumer mortgage debt accounts for approximately $12 trillion, which is spread across over 80 million mortgages. Of this $12 trillion, Fannie Mae and Freddie Mac, collectively known as the enterprises, guarantee approximately 70% of the market. The FHFA, the entity charged with supervising the enterprises and acting as their conservator, must be immune to political agendas, regardless of how much any administration pressures this agency. The FHFA therefore retains an exceptional degree of authority to impose rules that shape the entire mortgage market. It is this authority that brings us here today. In light of recent proposals to change the loan level pricing adjustments set forth by FHFA to be implemented by the enterprises. So when created in 2008, loan level price adjustments, LLPAs, were also known as guarantee fees. They were put in place to allow the enterprises to charge for the credit risk associated with mortgages that they were guaranteeing. These fees are designed to cover the risk of standing behind the mortgages and to protect the solvency of the enterprises. The recent changes to these fees that went into effect on May 1st, however, are alarming because they disproportionately increase fees for borrowers who have higher credit scores. Any way you slice it, prices will go up for consumers who have credit scores above 680, and even for some of those with down payments of more than 30% of the loan. So in other words, this pricing scheme would shift most of the cost burden to more creditworthy borrowers. The FHFA contends that the loan level price changes are attributed to higher capital standards that need to be imposed on the enterprises. While this could justify some change in LLPAs, the change we saw imposed on May 1st clearly targeted new home buyers with average credit scores and above. And we've also heard from that the FHFA contends that interpreting the new LLPA chart must be coupled with mortgage insurance coverage, so as to paint a full picture for consumers. And while those with lower credit scores and low down payments are certainly likely to pay more on mortgage insurance given the risk they present, this is an entirely different credit product whose fees cover the cost of the insurance itself and go to an entirely separate entity. Mortgage insurance payments do not help the enterprises to build capital or to actually protect the taxpayers from risk. Make no mistake, these changes to the LLPAs ultimately hurt housing affordability for the majority of home buyers. Even if it's a relatively small cost for some, it's inappropriate to place the burden on Americans simply because there is a misguided notion that they can, quote, afford it, especially with the high cost of inflation that's plaguing our economy. Now, to be fair, we've already seen the FHFA reverse course on some components of the LLPA changes. And while also issuing a request for input on its method for determining LLPAs. So these are positive but small steps in the right direction, and while we welcome these changes, they are insufficient. This committee will ensure that we have appropriate risk-based pricing and an efficient mortgage market. And so the witnesses here today will be critical to providing insight into how we can get that done. So I thank our witnesses for their testimony today, and I look forward to the conversation. The chair now recognizes the ranking member of the Subcommittee on Housing and Insurance, the gentleman from Missouri, Ranking Member Cleaver for 5 minutes for an opening statement.
Thank you, Mr. Chairman, and I thank you for calling the hearing. Let me first start by acknowledging that GSE pricing frameworks are not the most digestible set of information. Housing finance is complex. The complexity then leads itself to misunderstanding and sometimes to deliberate misinformation. I read a Fox News article last month entitled Real Estate Expert Shreds Biden Rule Punishing Home Buyers with Good Credit. The argument was presented that pricing changes were a punishment for home buyers with good credit designed to subsidize loans to higher risk borrowers. And the expert, by the way, was a former media host. I've since seen these claims repeated in several other media outlets. The Washington Examiner, for example, called it Biden's socialist housing scheme. Reasonable minds can disagree resolutely about how to implement a complex pricing framework, and I appreciate the request for input released by Director Thompson earlier this week. But I fervently disagree with the way in which individuals have taken the liberty with the motivations of FHA or mischaracterized FHA's actions. We will get to the bottom of these claims, hopefully, during the hearing. Last year, I called on the FHFA to do a holistic review of upfront fees. The old FHFA pricing framework was extremely unfair. The GSEs were unfairly overcharging borrowers with lower down payments who had the added protection of private mortgage insurance and underchain charging others. The new pricing framework was a recalibration that was warranted given the implications of a new capital regime in 2020. The new framework is not perfect, but it is fairer. Under both frameworks, no one is rewarded for having a lower credit score or making a lower down payment. Borrowers with lower credit scores and lower down payments continue to pay more than borrowers with higher credit scores and higher down payments, despite the adjustment made. These borrowers are some of the highest credit borrowers in this country. The average credit score of a borrower in one of the GSE's flagship affordable mortgage programs is 743. Those are prime credit Americans who simply don't have a great amount of wealth. They just want a reasonable chance for their family to own a home. In urban America, in suburban America, and thousands of rural communities around this country, the average borrower with an enterprise-backed mortgage is expected to receive a minimal increase of 4 basis points or 0.5% on their interest rate with these changes. Yet the undersupply of housing has driven a nearly 300 basis point mortgage rate, and it increases by 2020. Mr. Chairman, I appreciate this opportunity for us to discuss this important issue. The country needs Congress to get past these narratives that turn Americans against each other. Thank you.
Thank the ranking member. Today, we welcome the testimony of Edward J. DeMarco. Mr. DeMarco is president of the Housing Policy Council. Prior to joining HPC in June of 2017, he was a senior fellow in residence at the Milken Institute's Center for Financial Markets. From 2009 to 2014, Mr. DeMarco was acting director of the Federal Housing Finance Agency, where he served as the conservator for Fannie Mae and Freddie Mac and regulator of those companies and the federal home loan banks. Kenny Parcell. Mr. Parcell is the 2023 president of the National Association of Realtors. Kenny is a broker and owner of Equity Real Estate Utah. At the national level, Kenny served as NAR's Vice President of Government Affairs in 2018. In 2021, Realtor Magazine named him as one of its 30, under 30. Clifford Rossi. Mr. Rossi is an executive in residence and professor of the practice at the Robert H. Smith School of Business at the University of Maryland. Prior to entering academia, Mr. Rossi had nearly 25 years of experience in banking and government. His most recent position as Managing Director and Chief Risk Officer for Citigroup's Consumer Lending Group, where he was responsible for overseeing the risk of $300+ billion global portfolio of mortgage, home equity, student loans, and auto loans with 700 employees under his direction. Janneke Ratcliffe. Ms. Ratcliffe is Vice President for Housing Finance Policy and leads the Housing Finance Policy Center at the Urban Institute. Ms. Ratcliffe came from the Urban Institute, where the Consumer Financial Protection Bureau came to the Urban Institute from the Consumer Financial Protection Bureau, where she served as an assistant director, leading its Office of Financial Education. Ms. Ratcliffe serves on the Consumer Affairs Advisory Council of the Mortgage Bankers Association, and she is a member of the National Community Stabilization Trust Board of Managers. So we thank you for taking time to be here. You will each be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written statements will be made part of the record. Mr. DeMarco, you're now recognized for 5 minutes to give your oral remarks.
Good. Thank you, Mr. Chairman. Chairman Davidson, Ranking Member Cleaver, and members of the subcommittee, thank you for the invitation to participate in today's hearing. I am here on behalf of the Housing Policy Council, a trade association comprised of the leading national mortgage lenders and servicers, mortgage, property, and title insurers, and technology and data companies. My written statement provides HPC's views on today's topic and offers HPC's perspective on the relationship between pricing, capital, safety and soundness, and expanding homeownership opportunities. The statutory purposes of Fannie Mae and Freddie Mac, combined with FHFA's statutory responsibilities, indicate that Congress expects the two companies to advance the stability and availability of mortgage credit while operating in a safe and sound manner. In other words, Fannie and Freddie have a mandate to facilitate and support the liquidity of the secondary mortgage market. Accomplishing this purpose directly enhances the availability of mortgage credit throughout the country and lowers the cost of such credit to homebuyers. Congress went a step further and instructed that Fannie Mae and Freddie Mac take steps and meet specific goals to expand mortgage credit availability in identified geographies and for low and moderate income families. For purposes of today's discussion, I will divide FHFA's most recently announced pricing changes into two buckets. First, FHFA introduced and then rescinded a new upfront fee adjuster based on the borrower's debt-to-income ratio. Second, FHFA made adjustments to the pricing grids that establish upfront fees calibrated to Fannie and Freddie's risk in a particular transaction. Risk to Fannie and Freddie. HPC and others quickly recognized the challenges of the debt-to-income pricing element, and we asked FHFA for an implementation delay, which FHFA granted. After additional evaluation, HPC concluded that the proposed pricing element simply was not workable. We sent a detailed letter to FHFA on April 28th outlining our reasons for this conclusion. On May 10th, FHFA announced it was rescinding the DTI pricing element, and HPC is grateful for this reconsideration. As for the recent changes to the upfront grids, they appear to be reasonably aligned with credit risk after accounting for the new capital framework, the cost of private mortgage insurance, and historical default and loss data. That said, only FHFA has the detailed data and models to explain fully how the grids align with risk and the recently finalized risk-based capital framework. This opacity may have contributed to the confusion and misreporting regarding the January announcement. HPC and its members believe the solution is to have greater transparency regarding the pricing across risk categories relative to these capital standards. My statement elaborates on this point. I'd like to specifically address HPC's views on expanding sustainable homeownership. HPC and its members do not believe that subsidized pricing or more lenient underwriting, both of which increase risk and the cost of losses, is the way to go. Rather than ignoring risk or trying to compensate for it by charging all borrowers more, the government would better achieve sustainable expansion in homeownership with forms of assistance that lower borrower risk. I've testified on this issue before in front of this committee, and my written statement also elaborates on this point. HPC and its members would also like to point out that this entire discussion of G fees reflects how poorly targeted the pricing framework is for accomplishing the GSE's housing mission. Congress established GSE housing mission goals to advance certain affordable housing priorities. It is unknown how much the goals actually benefit the targeted households, rather than simply being absorbed by other parties to the transaction, creating leakage of the intended cross-subsidization benefit to the consumer. There would be far greater transparency of how much financial support actually reaches low and moderate income families and communities if the subsidy were directly allocated to those borrowers, not embedded in the price between the lender and the GSE. Thank you again for having me here.
Thank you, Mr. DeMarco. Mr. Parcell, you are now recognized for 5 minutes to give your oral remarks.
Chairman Davidson, Ranking Member Cleaver, and members of the Financial Services, Housing, and Insurance Subcommittee, thank you for your service, and most importantly, thank you for your time. My name is Kenny Parcell. I'm a broker-owner of Equity Real Estate Utah. I've been a Realtor member for over 27 years and now president of the National Association of Realtors. Today, I'm on here on behalf of our 1.5 million members who live and work in every zip code in America. We are the nation's largest trade organization. Thank you for the opportunity to share a perspective on the housing market and the recent pricing changes announced by the Federal Housing Finance Agency. It's no secret that today's market poses many obstacles for home buyers. Typically, first-time buyers make up 40% of all buyers. It is now at an all-time low of 26%. This is a very concerning stat. Interest rates have risen nearly 3 percentage points over the last year. In March of 2022, if you had a loan of $400,000 at 3% interest rate on a 30-year mortgage, your principal and interest payment would have been $1,682. Now that same loan amount at 6% would put your payment at $2,398. That's a 42% increase. With cost of inflation, additional fees, we have a real concern. Housing affordability and availability remain extremely restricted. Our members navigate these issues every day, which is why crucial for buyers and sellers to have a realtor on their side. I've learned the hard lesson by not using a realtor. I purchased my first home going into my sophomore year in college. I was a young student athlete and all I wanted to be was a homeowner. I had 3 years left on my football scholarship and I didn't want to rent. I had a dream of being a homeowner. Although it wasn't easy, when I closed on my first home, the seller removed the good white refrigerator and replaced it with the lime green one that didn't work. The kitchen cabinets were taken. The AC and garage door were removed. For the first 6 months, I lived out of a camping cooler. I would take the ice from the training room and bring it back to restock my cooler at home. It was a proud day when I eventually saved up enough money to buy a used refrigerator. I still own that home today, and it has increased in value by over $300,000. This experience led me into real estate and later NAR leadership. Our members abide by the code of ethics and consumers' best interest at heart. Realtors are committed to making the American dream accessible to more people, whether helping them navigate a difficult transaction like my family faced, or finding a solution to the supply and affordability crisis facing home buyers nationwide. A recent report from NAR found that we are at a 5 million unit shortfall. Underbuilding, high interest rates, and rapid price increases are eroding housing affordability. Homeownership is still viewed as a vital part of the American dream, but it's becoming increasingly out of reach for many. The average net worth of a renter is $8,000. The average net worth of a homeowner is over $320,000. The percentage of homeownership for whites is 74.4%, 45.8% for blacks, 61.6% for Asians, and 49.7% for Hispanics. We must and should improve these statistics for minorities. We believe any fee increase right now is not good for anyone wanting to purchase a home. This brings me to FHFA's recent loan level pricing adjustments, or LLPAs. NAR believes this pricing was missed opportunity to help Americans who are already struggling to afford homes. NAR has worked with FHFA on the issue for years and raised concerns of the fees in January. Given the sharp rise in interest rate over the past year, we knew these changes would harm borrowers in an already tight housing market. Additionally, with economic concerns mounting as Congress debates the debt limit, these fees only serve to further de-incentivize potential buyers. We are grateful for FHFA for listening to the concerns like these across the industry and announcing it would rescind its upfront fee on borrowers to the debt-to-income ratios greater than 40%, which was set to take effect August 1. NAR will continue to work with FA and Congress to find solution to lower barriers to homeownership while minimizing risk to taxpayers. It's like we're all in the same boat, but there's a hole in one side. And the people on the other side yell out, "Thank God the hole's not on my side." We need everyone's help on this important issue. It will take bipartisan approach to address the housing affordability crisis in our country. Thank you for the opportunity to testify. We appreciate your time, and I look forward to your questions. Thank you.
Thank you, Mr. Parcell. Dr. Rossi, you're now recognized for 5 minutes to give your oral remarks.
Thank you. Chair Davidson, Ranking Member Cleaver, and members of the subcommittee, my name is Clifford Rossi, Professor of the Practice, Executive in Residence at the Robert H. Smith School of Business at the University of Maryland. I offer a unique perspective on this issue, having worked for 23 years in the financial services industry in a variety of C-level risk management positions, including 10 years at both Fannie and Freddie, where I actually helped design and work on the analytical methodologies that we're here to actually talk about today, used in pricing enterprise guarantee fees and risk-based underwriting matrices. There remains much confusion over the process employed to price credit risk by the enterprises, and like much of the housing finance system, that credit pricing process is based on a legacy structure that in a perfect world would never have likely been designed the way it is today. Of critical importance to this hearing is the issue of cross-subsidies among mortgage borrowers. Changes in the LLPA grids that went into effect on May 1st sparked enormous controversy over the extent to which high credit quality borrowers are subsidizing low credit quality borrowers. I, too, in opinion pieces, raised concern over the appearance that fees on some high credit quality borrowers would rise while reducing fees on a number of low credit quality borrowers. Those are immutable facts. The current and previous LLPA grids incorporate elements of risk-based pricing, though the current grids flatten that relationship between key risk attributes and credit default. Another fact is that the cross-subsidy in credit pricing has been in place for decades by way of average guarantee fee pricing used by both enterprises. Effectively, then, what we see is a hybrid form of credit pricing that features flat or average pricing for the ongoing or guarantee fees and quasi-risk-based pricing, I don't call it actually risk-based pricing, for upfront fees or LLPAs. About the time of the financial crisis, as both GSEs came under increasing stress from accelerating credit losses, they turned to a new device to raise funds to staunch those losses, LLPAs. The LLPAs are essentially an artifact of a last-ditch effort by the GSEs to save themselves rather than as a well-thought-out credit pricing structure. The seminal question here is whether such a pricing scheme is the best structure to achieve the FHFA's objectives cited earlier. So in designing an optimal mortgage credit pricing structure for the enterprises, I have a set of criteria that are essential in guiding that. And these principles are as follows. 1, any credit pricing structure must achieve the FHFA's goal of ensuring the safety and soundness of the enterprises. I think we'd all agree about that. Credit pricing must be transparent and straightforward to understand. Credit pricing must be empirically based, reflecting a through-the-cycle view of loan performance, taking key risk attributes into account. Credit pricing should be operationally tractable and designed to minimize implementation burden for the enterprises and mortgage originators. And finally, credit pricing must seek to reduce and or eliminate perverse incentives that may pose risk to borrowers or the GSEs. So how do the current LLPAs actually comport with these criteria? Well, use of the Enterprise Regulatory Capital Framework, or ERCF, along with the modeling approach for generating guarantee fees, aligns generally with the first and third criteria. But the introduction of LLPAs violates the second, fourth, and fifth. So while on the surface, it can be argued that the LLPAs are transparent by virtue of pricing by risk attribute, the exact mechanics are murkier, thus setting the stage for second-guessing the new LLPA grids and the need for a new approach. So I actually propose eliminating the current FICO LTV LLPA grids altogether and updating the guarantee fees consistent with achieving a target rate of return taking into account the ERCF, that is the regulatory capital requirements. So my proposal meets all the stated criteria of mortgage credit pricing laid out earlier, and a precedent has already been set, as we said earlier, that with the FHFA's announcement for rescinding the LLPA fee for debt-to-income ratio. So instead of imposing LLPA fees for FICOs and LTVs, what I suggest is a part of the guarantee fee would be determined by the FHFA to use as a legislatively capped rebate account of sorts to borrowers that are income and or wealth challenged. There's ample precedent for these kind of guarantee fee on tops for various reasons, such as the FHFA's requirement over the years to add 10 basis points to guarantee fees to provide additional coverage for credit exposure, and let's not forget the 10 basis points adjustment for TCCA. The proposal decouples safety and soundness objectives from affordable housing and credit pricing, and that's important. We need to decouple credit pricing from these other policy objectives. and thus it provides transparency in credit pricing, reduces operational burden, reduces risk to borrowers and the enterprises, and supports the goal of affordable housing. Thank you very much.
Thank you, Mr. Rossi. Ms. Ratcliffe, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chair Davidson, Ranking Member Cleaver, and members of the subcommittee. Thank you for the opportunity to testify today. I would like to start by mentioning that what I present today is based on my own views and should not be attributed to the Urban Institute, its trustees, or funders. I've been invited to discuss pricing decisions with regard to the loan level price adjustments. This complex topic has generated concern and confusion. I hope that analysis by me and Urban Institute colleagues will help make things clearer. In my written testimony, I provide additional context around LLPAs first introduced in 2008. First, I want to emphasize that the recent adjustments to the LLPAs do not in any way compromise the safety and soundness of the GSEs. All enterprise loans today are underwritten according to strict risk criteria and present low risk by historical standards. Indeed, even those falling in the lower right quadrant of the pricing grid with down payments less than 20% and credit score between 620 and 680 have low projected losses. We estimate less than 1%. Moreover, these made up less than 3% of Fannie Mae's 30-year fixed rate purchase single-family owner-occupied mortgages in 2022, so a relatively small share. Secondly, rather than thinking about these adjustments as new cross subsidies, they should be viewed in light of a series of changes made by the director to better align pricing with the capital requirements established by the prior director under the Enterprise Regulatory Capital Framework, the ERCF. The GSEs exist to support sustainable and affordable homeownership across communities and across cycles. GSE pricing is primarily structured so that they can meet their capital requirements and their overall target return on capital. They can set different profit margins for different types of loans, which is a standard business practice, in order to maintain safety and soundness, serve their public mission, and meet their overall return target. For example, they charge the same fees for loans in all states, even though some states have higher default rates than others and are thus less profitable. They also have different margins on some products based on competitive pressures. Within the current pricing structure, it's helpful to recognize 3 categories the GSEs do price differentially. First, mission remote loans like second homes, investment properties, $1 million loans, and cash out refinances, which are seen as less appropriate for deep public support and less central to the basic homeownership mission. For these loans, they charge as much as they can while still providing enough benefit to retain that business. These higher returns offset lower return targets on a second category, mission loans, which include mortgages to people with lower incomes in rural markets, manufactured homes, and a few other categories. For this category, the aim is to price as low a margin as possible while still meeting profit targets, a practice that inherently makes these loans less risky. Then we come to the third category, the bulk of the loans. These are purchase and rate term refinances for all other owner-occupied homes, which are priced to hit capital requirements and target return on equity. The May 1 adjustments apply to the core loans. The May 1 pricing adjustment is the last in a series of steps taken over the past year, each to address different objectives. This has led to some confusion because these steps are being conflated, leading some to conclude that these changes are supporting mission business at the expense of the core business, but that is not correct. The May 1 changes result in a flatter grid across the core business. They give more credit where it is due for private mortgage insurance, and they split up some of the prior groups into smaller groups. The May 1 additions are relatively small, adding at most $40 per month to the median mortgage, and this adjustment applies to less than 1.5% of the core borrowers. Groups within the grid are all still priced to cover losses and make a profit. Finally, in the core business, which is the vast majority of their lending, those who pose more risk pay more, in some cases a lot more, than borrowers who pose less. Borrowers with low down payments or high LTV, which stands for loan to value, have to buy private mortgage insurance. Private mortgage insurance reduces losses to the GSEs and also raises costs for borrowers with LTV over 80%, who were likely overcharged in the prior grid, especially those with lower credit scores. With the May 1 changes on a $300,000 mortgage, a borrower with a credit score of 660 and 5% down will still pay around $500 more per month. $500, I just want to emphasize that, in LLPAs and PMI than a borrower with a credit score of 700 and 25% down payment. Ultimately, the May 1 changes have little to nothing to do with cross-subsidy. They better align the core business LLPAs with the capital requirements and losses, and they address previous overcharges among high LTV borrowers by accounting for mortgage insurance. Thank you, and I look forward to your questions.
Thank you, Ms. Ratcliffe. We'll now turn to member questions, and the chair now recognizes himself for 5 minutes for questions. Regarding FHFA's LLPA changes instituted on May 1st, first, the pricing changes announced, both the LLPA and the DTI, did not sit well with many. It's a bit of an understatement. But second, the process, such as there was one, that FHFA used to convey these changes through a couple of press releases was neither formal nor inclusive. Third, FHFA can, and in the case of DTI did, make changes to its pricing plans when they fell flat. So its argument that, quote, we had to do it this way doesn't really add up. And fourth, the data FHFA says that justifies the changes has either been not available nor or at least not transparently presented. So which stoked a lot of opposition. So it's really FHFA's burden to explain its own work, and FHFA fell far short of those standards, which is why we're having this hearing. It is also why we've attached a discussion draft of a bill to this hearing to have FHFA revert back to the old LLPA pricing for now, to have a GAO study of the process so that we can study what they did do to get to this point, and then require FHFA to use a transparent process if future changes are in fact merited. So quite simply, we ought to ensure fairness, oversight, and accountability when it comes to matters affecting the mortgage market. Does anyone on the panel disagree with that? I don't see anyone. Does anyone claim that it would do harm to do it this way? So that's the basic goal, and so I appreciate the quiet but affirmation of that. And I just want to highlight a couple things that were out there. So, Mr. DeMarco, if the 2023 price changes were actually about capital rule compliance, now that FHFA has rescinded its proposed DTI fee, folks like Ms. Ratcliffe have noted, quote, penalizes lower income borrowers, doesn't that mean that the GSEs will now have some level of capital shortfall since they're not going to implement the DTI rule? Would you support FHFA further revising LLPAs to raise fees again on GSE borrowers to backfill the missing revenue stream, or what are they going to do to hit the higher capital requirement they said they were going to try to hit? Mr. Rossi? Yeah. Mr. DeMarco, sorry, Mr. Rossi. Go ahead.
So I think FHFA itself, both in its G-fee study published last November, and in particular, they made it even more clear in the request for input that they published this week, that in fact, the current G-fee, the new G-fee framework is not going to produce the target rate of return given the increased capital requirements that were finalized in 2020 and became effective in 2022. And I think this is really a root issue in this whole discussion, right? What was done under Director Calabria in terms of material increase in the capital requirements for Fannie and Freddie included in those increases not just a very granular approach to pricing mortgage credit risk, but also ensuring that there was a base amount of capital across all mortgages. So even lower risk mortgages, through the way the capital rule was put together, have a substantial capital requirement, additional capital requirement. So it's not surprising then that as one comes along afterwards and is trying to align G-fees to this new capital framework, that one would see the sort of pricing changes that were done. I think this really was done to align with those framework. But because capital is so much higher, I'm not going to be surprised if there are additional capital raises that take place over time.
Yeah, so
I'm sorry, G-fee raises that take place over
may
time.
not be done yet, and to the point, say, well, it's no big deal. So Ms. Ratcliffe illustrated on page 12 of her testimony that about half of all GSE loans, 46%, are facing higher LLPA costs, so that less than a third can wind up with lower costs. And that's on the new assessment. I understand it's not lower in aggregate, but it's this assessment. So there's kind of this bonus round where we're going to assess it to try to get higher capital standards. So, Mr. Rossi, does it strike you as something that would sit well with regular Americans to buy a home? Do you see why many constituents would regard this shift in the balance as unfair?
Absolutely. And I don't personally like the,
I'm sorry I gave you no time. I am going to run a little tighter gavel, and I'd love to get your answer in writing when you get a chance.
Okay.
I now recognize the ranking member for 5 minutes.
Thank you, Mr. Chairman. Ms. Ratcliffe, leading civil rights agencies and organizations like the Urban League and many of the housing advocate organizations have, as long as I've been on this committee, called for the elimination of LLPAs altogether. The argument is being made is that the LLPA pricing framework has had a disproportionate impact on borrowers of color and has been inherently unfair as it placed the burden of the enterprise's financial recovery and future catastrophic risk on borrowers of color, even though they were the victims of the financial crisis, not the cause. And so I'm a card-carrying opponent of the tendency to blame the victim. My question is, regardless of what Congress does, there will always be an argument that something could be done differently, or that there is a different and preferred way to analyze risk. Should the FHFA do away with LLPAs altogether, as suggested by some organizations, or do you see the value of perfecting the current framework, which has been worked on over the course of several FHFA directors?
Thank you for the question. I agree that LLPAs and the private mortgage insurance costs will tend to fall heavier on borrowers with low down payments and those who haven't had the chance to build as robust credit history. And I just want to remind everybody that all GSE's loans today represent fully underwritten loans with ability to repay. So these are not bad credit borrowers in any means. But in any case, borrowers of color are less likely to have savings and especially less intergenerational wealth than white borrowers, so they're more likely to need high LTV loans and thus pay higher LLPAs and pay for private mortgage insurance. So I think that there's a good case to be made for doing away with LLPAs and just having everybody pay the same for access to the same benefit. All borrowers who access the GSE loans are getting a government benefit effectively that our research estimates amounts to about $6 billion a year. So it's not really a tax so much as it's just a question of how do we give people access to this benefit. There's been an argument here today for doing away with LLPAs, and I agree with that. I just want to say it is complex because right now, because of the higher LLPAs on the mission remote loans, the second homes, vacation homes, investor properties, cash out refis, and high balance loans, those are actually creating the potential to be able to reduce the LLPAs while still making the loans profitable for some of the more real mission-oriented loans. So there's a baby in the bathwater of the LLPAs as well. But other than those cross subsidies, I would agree with Dr. Rossi on doing away with the LLPAs.
Mr. DeMarco, I'm interested in your response to that question.
Yeah. No, I would, I have a different position. I believe that risk-based pricing is an important element of operating a safe and sound financial institution. Fannie Mae and Freddie Mac are two enormous financial institutions that are integral to our country's housing finance system and to our financial system. And I believe that the capital required and then the pricing of a financial guarantee needs to be done on the prospect of risk. But Mr. Cleaver, you raise a very important question about how we go about providing support to those segments of our country that Congress has designated as, for whatever historical or other reasons, warrant support. And so what I go through in my testimony is, look, providing a mortgage rate subsidy to these home buyers so that instead of paying 6.5%, they're paying 6.25% or 6 1/8. That, I don't believe, is going to get us where we want to go. Instead, you think about the money that is being used to subsidize those rates. If that money was available and provided directly to the targeted borrowers, then we can work on enhancing their down payment, improving their credit position, providing them with rainy day reserves so that they're going to be more sustainable when in their mortgage. I think these are the sort of steps that we can take rather than subsidizing the rate. Let's provide that money directly to these families, and let's make sure we identify which families we're providing it to.
Thank you.
I thank the gentleman, and the chair now recognizes the gentleman from Florida, Mr. Posey, for 5 minutes.
Thank you, Chairman Davidson. When I first read the proposal that we're going to charge people with good credit more and we're going to charge people with poor credit less, I thought it was a bad joke. I mean, how that could possibly pass anybody's straight face test is a mystery to me. Professor Rossi, explain how the principle of risk-based pricing mortgage lending, should we preserve such principles?
So I'm a big believer, just to say at the beginning, in risk-based pricing in general, right? So basically what happens is that every loan that comes through that the GSEs purchase will go through their pricing engine. It'll take into account all the usual variables such as FICO score, loan or credit score, loan-to-value ratio, debt-to-income ratio, probably another 10 or 15 of those variables that you see in those LLPA grids. So we're already pricing for it in the G fee, in the ongoing G fee. And I want to be clear here. There's the ongoing G fee, and there's the upfront loan level pricing adjustment. So risk-based pricing is inherently good. We all do it every day, right, with auto insurance, right? We see that we each pay based on our driving habits and everything else, but it's different in the GSE world because we have this other dimension to it. And so it's not the case that I personally believe risk-based pricing has a purpose. I think it should be risk-based price into the G fee. Every loan should be risk-based price, but then we average it at the end, just like we do today. So 45 basis points, I think, is the average guarantee fee.
Mr. Parcell, what are the views of the Realtors across the nation on this?
Thank you, Mr. Congressman. We're against any increase in fee, period.
You know, and a lot of people have, in your written testimonies, you've offered some solutions, but it would seem to me it's so simple. I mean, inflation, do we all agree that inflation drives the price up? Do we all agree inflation makes it harder for low-income people to purchase homes? Do we agree that inflation makes it harder for them just to pay their bills every month, much less qualify for a home loan? All heads show unanimous on that. So, you know, why the administration won't do something to fix that? The administration's raising rates to try and stop the inflation that it caused because it's trying to kill the fossil fuel industry. Nothing in this room does not have a fossil industry component to it. I mean, the federal government is causing these problems and then asking people to come in and help solve it when the federal government could solve the problem really relatively quickly. Housing shortage for everyone to have a home is nothing new. I mean, that's been around since the beginning, and we've tried to do everything possible, I think, the government, to make that, as some consider the American dream, possible for every family. We know it helps generations. Every generation is better off until possibly this one than the generation before because ownership of the rock has expanded, and we really want to do that. But it really seems that we're trying to solve a problem that could easily have been solved, that could easily be solved with almost a snap of a finger. We could bring prices down, we could bring affordability down. Anybody want to dispute that on this panel?
No, Congressman, more houses would certainly help.
Mr. Congressman, a few things that could help immediately is the capital gains exemption for your primary residence. That was a law that was passed in 1997. It was $250 if you're filing separate, $500 if you're joint. There's people that are in their homes that would like to downsize, but they do not want to take the capital gains hit. So things have changed since 1997, so you all could help with that. There's also several commercial office space that's not being utilized with COVID. There's people not coming, that we could use some of that commercial space for conversion to home ownership. So those are things that we would all welcome your help with, for sure. Thank you.
Anybody else?
I have one. I would say if we eliminated the 10 basis points on the on top on guarantee fees today for payroll tax, that'd go a long way too.
Thank you. Mr. Chairman, my time's about to expire. I yield back. Thank you.
Thank you, Mr. Posey. The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you to all the witnesses for being here today. I would like to begin by expressing my concern that this is the first hearing that we have had, in fact, on housing in this subcommittee, the Housing Insurance Subcommittee of this Congress. Our nation is facing a housing crisis, and this committee did constant work on this issue under the leadership of then Chairwoman Waters. Now, however, the Republicans' majority has chosen to ignore this very important housing issue and focus on one political and highly technical issue. In fact, as I've been listening to some of your testimony, I think even I may have gotten a little confused there for 1 minute. So my first question is about this issue that Republicans have decided to focus on and why it can actually be an effective tool. Ms. Ratcliffe, according to the National Fair Housing Alliance and National Consumer Law Center, credit scores begging a history of discrimination. Today's median FICO score is 742, which is much higher than individuals' credit scores throughout the nation, particularly in the South. Borrowers in my home state of Texas and states like Georgia, Mississippi, Louisiana, Arkansas, and Oklahoma had average credit scores less than 700 in 2020. Do you believe that FHA's recent pricing changes will help first-time home buyers in these states access home ownership through conventional loans?
Thank you for your question, and I do want to clarify that LLPAs went down for borrowers with many borrowers with lower credit scores and many borrowers with higher loan to value compared to where they were in the previous grid.
When you say many, it's not all. So
Certainly, it's not all of them.
Many would be how many? Less than half, 1/3, 20%?
Good, I can work out the numbers while we're sitting here, but not right off the top of my head. But I'm just emphasizing that when people say people are paying more, it's not that higher credit score borrowers are paying more than lower credit score borrowers. It is that higher credit score borrowers are going to pay a little more than they paid before May 1 if they had gotten their mortgage before 1, and lower credit score borrowers would be paying less than they did before May 1, but they are still paying substantially more than borrowers with high credit scores. So I just want to clarify that. For sure, because of the weight of the fees and the slight reduction for people with lower credit scores, this should be more helpful in areas where more borrowers have lower credit scores. Again, to emphasize, all GSE loans are carefully underwritten. These are good quality borrowers, all of whom are expected to be successful in home ownership.
So you think it would help first time?
Marginally, yes, it certainly
Okay.
would.
Well, I tend to agree with you, and I believe that supporting first-time home ownership is not only essential, but in fact the responsibility of this subcommittee and all of us to encourage. I would like to use this opportunity to use the expertise of these witnesses to focus on other issues that have been ignored by the Republicans. I'd like to discuss how Congress can support home ownership, particularly for low-income borrowers of color. My district is 77% Latino, and Latinos are on track to become the largest group of home buyers in the nation very soon. Ms. Ratcliffe, how best can we support home ownership as potential buyers face high down payments, lack of generational wealth, a housing shortage, and high interest rates? Easy question.
Very well, and I think there's many good answers here on the panel today. I will say there's no single silver bullet. I feel like it takes a bipartisan, coherent, across-the-board effort at the national and local level. The biggest issue right now is lack of housing supply. I think we've already heard that, both for rental housing and home ownership, and this is driving up prices. So it's really important to focus on supply. There's many ways in which the federal government can find ways to subsidize the building of affordable housing, both for rental and home ownership. I won't go through the whole list. I just want to say that at the same time that we're looking at the supply side, we also need to be sure to empower the borrowers, the homeowners of the future, the generations of the future to become homeowners, and that can be done through things like down payment assistance, perhaps interest rate, buy-down subsidies, things like that to support first-time home buyers, as well as to help certain types of housing supply, like better loan options for manufactured housing, for purchase rehab lending, perhaps for condominiums as well. So across the board, these solutions could work together.
Mr. Rossi, you were nodding. Did you want to? Add
I'm
something?
nodding because that was very eloquently stated, and I'm not sure that I have much more to say other than I think that, as she said, there are many ways to get at this, and one of the ways is to be able to think about separating credit pricing as part of the mission of FHFA from the mission.
Thank you, and I yield back.
Ladies' time has expired. Chair now recognizes the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. I'm going to yield briefly to my colleague from South Carolina, Mr. Norman.
Thank you, Mr. Garbarino. I got a press conference I got to go to. This is the stupidest idea, raising these rates, what they're doing, charging those with good credit. I've been a realtor for 40 years. I built a lot of houses. The supply shortage is because of what this administration is doing with our energy policies. There are no battery-operated dump trucks. And I don't know what affordable is for housing. I have no idea. But to penalize people for a good credit report, that's a joke. And also, the credit card. Try getting a credit card when you don't pay your bills. You pay a higher rate, and you should. This isn't a racial issue, black, white. This is a common sense issue. It's the backward way to do things. I yield back.
Thank you. A couple of questions. Mr. Parcell, I want to start with you. Prior to getting here, I was a private practice attorney, did hundreds of closings. I know that the spring is usually the best time for the housing market. Right now, we've seen the Federal Reserve approve its 10th interest rate increase in just over a year. Can you describe what you and your members are seeing today in today's housing market? How's it changed? Are we seeing fewer or more people purchasing homes right now?
Thank you, Congressman. We are seeing fewer people. It's the affordability factor going into it. It will break your hearts when you see that single mom with a mother of 3 children with the rent increase, and for them just trying to get into a home. We're exploring, you're always trying to educate on rural housing loans, FHA loans. There's some community grant programs. Many states are giving down payment assistant grant programs where you pay that back. But it is a huge issue, and that's why we're very much against any rate or fee increase at this time. It's just not the time for it.
Which is why I question why the FHFA is coming out with this policy change now. Can you tell us who would mostly be affected by this change?
It affects all buyers. It's going to affect all of them. And some people, you hear it say, well, it's only $30 to $40. $30 or $40 is a significant amount for that single mom or the military vet that is just trying to make it. And the school teacher that is on a fixed income, that extra $30 to $40, they don't have it.
Absolutely. And I think you mentioned it briefly in your testimony, but can you say it again, how much more the average borrower is paying for a mortgage now than versus May of 2021?
Correct. It was $1682, and it's nearly $2,400 just on that interest rate alone.
Yeah, it's insane. I know paying 6%, a lot of closings right now. 6% a long time ago, people would have loved, but what we've seen, it's just raising rates. And I'm also the lead of the SALT Deduction Repeal Act. I know the Realtors are very supportive of that, and that will also help. If we get that deduction back, I think that will help homeowners as well. Mr. DeMarco, I have a question for you. This hearing's titled "The Current Mortgage Market Undermining Housing Affordability with Politics," and mortgages are, the biggest, usually the cost and availability for mortgages to middle-class people allows them to buy what's probably the biggest asset of their life, but it's not the only cost. Title insurance is a cost that people face, and I've seen title insurance policies or having title insurance policies save homeowners from possible mistakes And the committee has heard a lot about a proposed pilot where Fannie would waive title insurance requirements and has acted essentially at the title insurer, to act essentially as the title insurer to a lender originating a mortgage. How does such of a program or activity fit into Fannie's statutory mission, in your opinion?
Title insurance is a primary market function. It is a critical element of protecting both the lender and the homeowner. While there seems to be a lot of murkiness about what's going on with some potential pilot, I mean, from what I've heard, it certainly is disturbing to think that Fannie Mae or Freddie Mac might displace title insurance by taking on this insurance itself. And I would trust that any such discussions are undergoing careful scrutiny at FHFA, would be subject to the new product rule at FHFA, and frankly, the GSEs simply do not belong in the primary market. We've seen attempts in the past to get into private mortgage insurance, hazard insurance, and so forth, and I would caution against that. They've got a big enough job keeping the secondary market working.
Absolutely. And as I said, I was a practicing attorney, and I did closings back in 2008, before the crash, or during 2007 during the crash, and I feel like both the rule that we're talking about today and this possible title insurance rule is going to be the start of maybe another downturn. I yield back. Thank you.
Thanks, Mr. Garbarino. The chair now recognizes the gentleman from Nevada, Mr. Horsford, for 5 minutes.
I thank the chairman and the ranking member for the hearing, and I want to thank our witnesses for your insight. I represent Southern Nevada, Nevada's 4th district. It covers 50,000 square miles in the state of Nevada. I have rural and urban areas, and we were one of the hardest hit states and regions after the last housing crisis. And housing affordability continues to be the most important issue that my constituents are concerned about. In fact, I just last week had the opportunity to host with our Southern Nevada Regional Housing Authority a regional housing summit with representatives from the Congressional Hispanic and Asian caucuses. I currently serve as the chair of the Black Caucus, and I was fortunate to have the ranking member, Ms. Waters, there as well. I just find it interesting that the framing of this with some of my colleagues is somehow people with good credit or overrepresenting and subsidizing in some way the impact to low credit score. First of all, the credit score is a joke. We need to reform the credit rating system because it's biased and it is inherently flawed in its methodology. It's not transparent, and I know under the leadership of the ranking member this was a priority, and I hope that under this Congress it can be as well. Now, the underlying issue with this LLPA notwithstanding, it is a factor, but it's not the only factor, as I heard several of you say. I did want to ask Ms. Ratcliffe if you could expand more on the historically underserved communities who are fighting to keep a roof over their head. And I agree with you that the May 1st statement, the LLPA adjustments are modest in nature and better align the balance of policy and market requirements that GSEs must consider. In your testimony, you note that while the number of significant variations is small, the recent pricing changes will result in some borrowers facing higher LLPAs and others will pay less. So can you elaborate further on which borrowers are in which buckets, please?
That's a great question, thank you. And again, I want to emphasize some will pay higher LLPAs than they would have paid before May 1, and some will pay lower than they would have paid before May 1, but the traditional relationship between higher credit score and lower credit score borrowers in the grid still remains. So I'll just give you some examples. These are some numbers from page 4 of my written testimony, but I have 3 loans I picked fairly randomly off the grid, but consider a borrower with a 700 credit score, which is towards the high end of the credit score distribution in the grid, and a 75% LTV or 25% down. They would have paid before May 1, they would have paid an LLPA that would have converted to a monthly payment of $50. And after the changes, that's going to go down to $44. That's on top of a mortgage payment on this is on a $300,000 loan of about $1,877 to begin with. So the mortgage payment's $1,877, the LLPA used to be $50, it will be $44. Now I'll take another borrower who has a 720 credit score, even a little better, but has an 80% LTV, so they're putting a little bit less down, 20%. They used to pay $38 per month on that same loan. Now they'll be paying $63 if they close their loan after May 1. So that's a little less than a $30 increase a month. Finally, we'll look at a borrower who has a credit score of 630 and just 5% down. So that's pretty far into the lower right-hand quadrant of the grid. On top of the $1,800 mortgage payment, they used to pay $175 a month in LLPAs, and that's going to go down to $88 a month. So still higher than anybody else's, but they're seeing the biggest decrease. And that's to take account for mortgage insurance, and I just want to add this, the mortgage insurance premium on top of that is $465. $465 in mortgage insurance.
Thank you. So I do think we need to look at this comprehensively. I wanted Mr. Parcell to note that I noted that the Realtors were pleased with the adjustment that was made on the LLPA's upfront fee on borrowers with debt-to-income ratios greater than 40% that was slated to go into effect August 1st, and I just wanted to give you an opportunity to elaborate on that.
Thank you, Congressman. Why that is so important, if you can put yourself in a mortgage broker's situation. The loan process comes in, they send it to underwriting, the buyers waive their earnest money because it's going through the underwriting process. That underwriter may flag that buyer and say, look, we don't like the overtime, we don't like the bonus structure, you no longer qualify, now it puts you over that 40%, and then that buyer is in a real pickle, and the mortgage broker can't honor that interest rate. Thank you.
I thank the gentleman. The gentlewoman from Texas, Mrs. Dela Cruz, is now recognized for 5 minutes.
Thank you, Chairman Davidson, for holding this hearing today. I appreciate all of our witnesses for being with us. My district is a unique community down in deep South Texas. My district is over 80% Hispanic, and I am really concerned about any increases, whether we say the increase is smaller than someone with a lower credit score or not. The point is that there are increases to housing. My question is for Mr. Parcell. In a district like mine that is over 80% Hispanic, how would an increase, no matter how quote unquote small it is, how would it affect a Hispanic community such as mine?
Thank you, Congresswoman. It goes back to when I purchased my first home. $30 to $40 would have devastated me and kept me out of that opportunity, and that's exactly what's going to happen in your district. It's going to push people to where they just can't qualify or put it too tight as it is. It's a skinny margin with the cost of fuel, cost of inflation, cost of food. Kids are more expensive. It is going to harm your people.
And so when I think about housing is so important for the community around its economy. You're not only talking about the sale of the house, but a broker who gets a fee or makes money, plus the city, plus going to the grocery store, things like that. So someone not purchasing a home in a community, like a rural community such as mine, it actually affects the overall economy of a city. Would you say that's correct?
100%. They're buying local stuff at the hardware store. They're buying stuff at the convenience store. They're grass clippings. They're mowing lawns. They're doing stuff which brings more property tax, which means bring more value to your city and county.
So it's important. How likely is it for someone who's actually purchasing a home in a city? Are they more likely to stay in that city and invest in that city?
100%. You're seeing that in test scores. You're seeing it all across the board. Crime, everything. If you're a property owner, a homeowner, things just go a little smoother.
So it sounds like to me that if you put a barrier such as an increase of even a quote unquote small increase on a potential homeowner, that really this is a layered effect, not only for the homeowner, but for the economy of the city. Is that correct?
Yes, Congressman, 100%. The best way to build wealth is through real estate, but it's also the best way to build back into the community is through real estate.
Thank you. With that, I yield back.
Gentlelady yields. The chairman now recognizes the ranking member of the full committee, gentlewoman from California, Ms. Waters, for 5 minutes.
Before I raise a few questions with you, this one had not been thought about a lot. We just accepted the fact that there, with inflation and the increased interest rates that some families are faced with, even though they tell me it's not a huge number, I'm getting from individuals who had these adjustable rate mortgages that their loans have increased over $1,000 in some cases. Can anything be done about that? Anybody? Mr. Ratcliffe, do you know?
So,
Ms. Ratcliffe.
to the extent that you're, Congressperson Waters, you are asking about people with adjustable rate mortgages who have seen their payments go up by $1,000?
Yes.
And I'm not, I would guess that those are probably not GSE insured loans, Fannie Mae and Freddie Mac loans, which shows the importance of having well-regulated loans that are structured more safely. Since the great financial crisis, new rules have been put in place to make sure that borrowers don't end up with these toxic kind of mortgages that can, explode on them. So I would be curious to know more about these lenders and who they are and how they're operating.
Well, I certainly appreciate that because, of course, all of us were around in what happened in 2008 and the devastation to not only families but whole communities as they ended up losing their properties, et cetera, et cetera. I don't know how many fall in this category of adjusted rate mortgages now, but even if it's only a relatively small number, they're going to lose their homes. And we don't know what's happening with inflation, except I'm told that it is coming down, but these housing costs are basically, what is happening with inflation. So let me go to Ms. Ratcliffe. I'm going to stay with you. I'm so pleased that finally my colleagues on the other side of the aisle are becoming concerned about the rising cost of purchasing a home. Last Congress, Democrats sounded the alarm about rising housing costs and how these costs are a key driver of inflation. And that is why I and my colleagues, committee Democrats, fought to secure substantial new housing investments in the Build Back Better Act. You're familiar with that, right?
Ma'am.
We had $150 billion in that act.
Yes, ma'am.
And in that act, we had money not only for Section 8 and for public housing, but for the development of affordable housing through the old act that we put together in order to increase units that were so desperately needed, and money for homelessness, et cetera, et cetera. And I'm still, feeling very bad about what happened and the support that we did not get. We did not get any support from the opposite side of the aisle. And that Build Back Better Act, which would have created 1.4 million homes and in turn reduce housing prices and inflation. Unfortunately, not a single Republican again voted in favor of it. But now I think, and I'm hearing and I'm learning that wealthy homeowners with vacation homes who were paying unfairly low fees under the prior FHA fee structure are now faced with the prospect of paying their fair share, and that maybe some of our friends on the opposite side of the aisle are seeing the light because they're upset about the housing costs. Meanwhile, the underlying lack of housing supply due to years of or disinvestment from the federal government and the private sector is continuing to fuel housing price increases all across the country, hurting those with lower incomes and lower wealth, and most even when they have excellent credit. Oh, let's not forget that our friends on the opposite side of the aisle, their concerns about housing prices come as they, pressured by the former President of the United States, President Trump, threatened to tank the national economy by forcing a default on the U.S. debt. So I'm bringing in something different here, a little bit different, because we're all thinking about what's going to happen, and are we going to be able to deal with this debt crisis that we're in? Are we going to be able to raise what we need? So having said that, there's a lot to think about, and I'm told that my time is up, and that's okay by me. I yield back the balance of my time.
The gentlelady's time has indeed expired. The chair now recognizes the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Mr. Chair. The changes to LLPAs raise the issue of the GSE's system of cross-subsidies, which are approved by the FHFA. The GSEs generate these cross-subsidies first by targeting a lower than market rate return on their lower income mortgage purchases, which they make up for by targeting a higher return on their other lending activities. Next, the GSEs charge higher credit risk borrowers a lower guarantee fee than would be warranted purely on a risk-based pricing basis, while charging selected low credit risk borrowers a higher guarantee fee than is justified by their individual risk profile and loan type or purpose. Mr. DeMarco, do these cross-subsidies distort the market by weakening the link between loan price and credit risk? And do the changes to the LLPAs lead to further distortion?
Congressman, I believe that, as I say to my written statement, mixing mission into the pricing is problematic, and it adds overall risk to the system, and I think we can deliver support to families in a much more direct way than doing it through the rate. That said, I feel like I really need to clarify here that how is this actually working with what FHFA has been doing. The cross-subsidy, if you will, is chiefly in what was announced last fall, where FHFA eliminated what was left in terms of LLPAs for mortgage holders that meet the affordable housing goals that are set in statute. And Congress actually tells FHFA that it can go ahead and have a lower rate of return on those loans. The loans that are covered by the grid changes made in January are driven not by cross-subsidization, it's driven by the capital rule. And if we want more capital, and if we're supporting this higher capital framework that was put in place by Director Calabria and carried forward by Director Thompson, we've got to come to grips with capital isn't free. There's a cost to capital. And I think what's going on in the grid change announcements that were made in January is focused not on cross-subsidization, is focused on making sure across the grid that we're earning a rate of return sufficient for the capital that has to be raised. And that's not just for now in conservatorship, it's preparing for a date in which these companies might be private and there's actual private capital there, because that private capital is going to want to earn an appropriate rate of return. So you raise an important question, and it gets complicated because it's different parts of the books of business that we're talking about, and I hope that my answer helped divide those up properly.
No, that's good. I mean, the cross-subsidies are based on the borrower's credit quality, right? They're affordable. The housing goals are based on the borrower's income.
They're based on their income, not on their credit score. So the housing goals are based upon the borrower income relative to the area median, or in some cases it's based upon geography, where the borrower lives, because Congress has also identified those as target areas.
Yeah, and I would further say that, I mean, and I've talked about this before, there's this whole group of adults right now in America between 25 and 35 years old that have been frozen out of the housing market, mainly because of the increases in real estate. But quite honestly, I mean, they couldn't generate the cash to come up with a down payment if their life depended on it. So, I mean, that's really what we're fighting through here, is we cannot allow, it's not a generation obviously, but it's 10 years, in which this group of adults are never going to have the opportunity to own a home and build wealth. That's our biggest issue.
Yeah, I think you've raised absolutely right. I mean, in some ways, this is, we are now paying the cost of having suppressed mortgage rates for so long, because it did contribute directly to to driving up house prices. We made the cost of mortgage credit so low, and those that were able to get in got in, and those that are coming online now as young families, it's much harder for them because now they got the double whammy of house prices have gone up, and now mortgage rates are much higher.
So in situations where low-risk borrowers face higher rates under the new fee structure, could a larger than expected subset of loans be originated away from the GSEs and open the door for more private market players?
At the margin, that's possible, but I don't think that what was done in this last grid change is a needle mover with regard to that particular question.
Thank you. I yield back.
The gentleman yields back. The chair now recognizes the gentlelady from Colorado, Ms. Pedersen, for 5 minutes.
Thank you, Mr. Chairman, and thank you all for being here today and for this very important hearing. It's hopefully the beginning of many conversations. I think about this all the time. Coming from Colorado, our secret is out. It's one of the best places to live, no offense to my colleagues, but people are moving there at a significantly high rate. Now, because it's become so unaffordable, it's starting to move in the other direction. But especially places in the 7th District in the rural communities. We saw through the pandemic people moving when they could work remotely, and we saw some of these houses increase threefold in just a couple of years and people being pushed out of their communities. This is something that hits every aspect of the challenges that places across Colorado are facing when it comes to hiring workforce for our small businesses, being able to keep our public servants in our community, to be able to hire our firefighters, our teachers. So this is why I asked to be on financial services. This is something that I plan to work with all of you on and everyone here on this committee to address accessibility and affordability. The thing that I oftentimes think about is really the housing crisis. We still haven't actually come out of that. We're still seeing some of the effects. We know that home builders were wiped out during that time. It took us back in our ability to actually increase capacity to build houses. We have a housing supply issue. And one of the number one barriers that we're facing is not just our ability to produce and build this, and I can't not talk about immigration reform and our failed policies there and actually filling the gaps. But it's also the rising costs with local permitting. I had the opportunity to visit a business in my district called Fading West, and their goal is to, mass production of houses like we do, approach it in a way that we do with cars, have assembly lines in a warehouse, be able to turn them out and make them unique to the communities that are buying them. They said that even though they're able to reduce about 20% of the costs there, one of the largest costs ultimately come down to all the local permitting processes. So it's not just about, it's what can we do to incentivize the mass production of houses, addressing the workforce shortages, and also incentivizing at the federal level some type of local permitting process and streamlining so that we can actually address some of these significant barriers that people are facing. First, I know I covered a lot there. Last thing that I'll talk about, you all mentioned mortgage insurance, and we've talked a little bit about this, and something that I found out as a homeowner, because I was lucky enough to get in right before the financial collapse. It's the only reason that I had any wealth as a public servant. But it was, I was paying for years mortgage insurance that I actually didn't have to pay. It doesn't automatically come off. You have to be educated enough to know your equity in your house, and you have to advocate for yourself. It seems like a really simple thing if we had that automatically come off to reduce costs as soon as you hit your 20% equity. Would like your opinion there, and also would like to hear your ideas around what we do around workforce shortage, how we address our immigration reform, immigration opportunities here in this country, as well as our local permitting process.
Go ahead, Janneke.
Oh, I did want to jump in and say that mortgage insurance should now automatically cancel at 78% LTV.
Great.
So,
Yes, I was going to say the same.
When did that go into effect?
It's been there for a long time, I believe.
That's great.
But Congresswoman, I think the point there
my bill
is
idea is gone.
Well, no, but I think, I mean, this is where homeowner knowledge can be helpful, because it automatically comes off based upon the amortization of the mortgage. But if the homeowner knows that their house price has been appreciating in their community, they can get it appraised and use that evidence to have the mortgage insurance removed sooner. And so this is about, it's important to have educated home buyers, and that's going to make home buyers more sustainable and smarter about the financial decisions they make.
And again, I just want to emphasize that because of the new pricing grid, many borrowers will actually see a decrease in their LLPAs, and a lot of that is attributable to the fact that in the previous grid, they were being overpriced because they were not being given enough credit for the capital and the losses that the private mortgage insurance protects the GSEs and the taxpayers from incurring.
Right, and then what I always talk about is our workforce shortage here in the United States, our inability to address the visas that we need for people who want to work here legally and a pathway to do so, and how that affects home builders as well. Can you all talk about the significant need in that area?
Would ask witnesses to respond if inclined in writing. The gentleman from New York, Mr. Lawler, is now recognized for 5 minutes.
Thank you, Chairman. I listened with great intent to the ranking member's comments, and yes, she's correct. Democrats controlled all branches of government and passed their housing agenda, and yet here we are, still talking about housing problems. So clearly the policies have failed. If you look at New York State, for instance, Democrats control everything in Albany. Housing policies have created 50,000 vacant units in New York City. Not looking too good. We talk about debt. The House Republican majority is the only one that have actually raised our debt ceiling. Thank you. Raised our debt ceiling. And President Biden just yesterday appointed a committee of 3 people to finally negotiate after stalling for several months. So yes, we're going to avoid default because the president has finally come to the table to negotiate with Republicans in the House majority. While I am glad to see that the FHFA has canceled their impending fees based on debt-to-income ratio, I find it frankly absurd that the administration has chosen to saddle homeowners with good credit with potentially thousands of dollars of additional costs on mortgage fees in order to subsidize borrowers with riskier loans. Moreover, the FHFA has further chosen to pursue unfair policies that socialize credit risk and disfavor responsible homeowners under the guise of making the housing market more equitable at a time when Americans are facing such a serious affordability crisis is especially shocking. One key and frustrating aspect of the FHFA's botched rollout of these changes has been the complete lack of transparency in the decision-making process. Mr. DeMarco, given your previous tenure as director of FHFA, can you speak about the process through which these changes were implemented? What stakeholders were interacted with? And do you believe the recently announced RFI is an important step forward for the public and Congress to provide commentary on changes to the GSE pricing framework?
So, Congressman, I can't speak to what process FHFA followed in making these changes. I suspect that it was based upon a lot of careful modeling analysis of both the capital rule and of historical data on defaults and losses given default. I expect they, obviously they've got quite a capable internal staff. I don't know what they did in terms of their communication with the GSEs or anyone else. I will say FHFA had been communicating and signaling that these changes were coming. And so the fact that it happened did not come out of the blue. They've been talking about this in terms of their scorecards and in terms of the GFI report that they issued in November, made clear that these kind of changes were needed because GFIs hadn't been changed yet to keep up with the changes in the capital framework.
All of your testimony made clear that you applaud the FHFA's rescission of the debt-to-income upfront fee proposal. The decision came after significant stakeholder feedback and congressional oversight, and I'm certainly pleased to see that this unworkable initiative was abandoned. But can you speak about the specific issues inherent with the DTI proposal for both lenders and borrowers? Do you see a scenario where upfront fee-based on DTI could be feasible for the market? And do you support congressional action to limit their ability to implement a DTI-based fee in the future?
So I'm not sure we need congressional action here, but I do think that it is unworkable. I mean, we spent several months, I'm working with the biggest lenders in the country, and we tried to find a way to suggest, okay, if you want to do this, here's how to make it work, and we concluded it simply wasn't workable, and I credit FHFA for stepping that back. But it's important to understand why. I mean, when a family applies for a mortgage, that mortgage goes through underwriting, and underwriting is really critical. And one of the fundamental things an underwriter is doing is trying to determine what is the borrower's ability to repay. They do that by wanting to learn how much income does this borrower have and how much other debt does the borrower have. And that is a ongoing process throughout underwriting, and what we've learned is that the answers to those questions are not easy. Someone that is not a straight salary W-2 worker can have a very complicated income stream, and it takes a while to figure that out. Hence, it's very hard to know debt to income when the borrower first applies for a loan.
Thank you. I yield back.
Thank you. The gentleman's time has expired. The gentlewoman from Georgia, Mrs. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman. My colleagues heard me say this yesterday, and I'll probably say it again and again and again until it changes. I represent the city of Atlanta, where we unfortunately have the largest racial wealth gap in the entire country. America and my constituents are sick and tired of hearing me say it and sick and tired of living it. And we all know that home ownership is the #1 way to build generational wealth. And that's why the best way that we can increase Black generational wealth is through home ownership. This means we need to be doing more to make home ownership a possibility and reality for people who have less wealth, especially when these same people were subjected to redlining and racist housing policies not very long ago and are still feeling the effects of those discriminatory practices today. According to the latest data from the Census Bureau, at the end of 2020, Black home ownership in Atlanta was 48.7%, and white home ownership in Atlanta was 75.6%. This isn't far off from the national rates of 44.1% for Black people and 74.5% for white people. As false information is spread by my colleagues on the other side of the aisle, I want to make one thing very clear. FHFA's recent mortgage pricing update helps borrowers with less wealth become homeowners. It might make it cost a little bit more for wealthy people to buy that second home, but I'm actually okay with that, given the number of my constituents that just want to own that first home. As you know, FHFA's pricing grid was first developed in 2008 in the wake of the financial crisis. Housing advocates have long pointed out that the pricing grid, which relies on credit scores and loan-to-value ratios, both of which tend to be predicated on wealth, has locked credit-worthy individuals out of home ownership for generations. As a colleague already mentioned today, credit scores are steeped in a history of discrimination. Consumers across every income bracket in the South typically have much lower credit scores than consumers living in the Northeast, Midwest, or West. Ms. Ratcliffe, given that FHFA's recent pricing changes help more first-time homebuyers in southern states access home ownership, do you think it's fair to say that FHFA's action is creating equity for everyday people who live in the South rather than lining the pockets of affluent investors?
Thank you for your question. This is a good opportunity. I think this is what you raise is why it is so concerning that we are looking at the old grid as though it was the right grid. The thing is, the old grid overcharged borrowers with lower credit scores and less wealth to put down on buying a home. And so when you run the numbers and you look at the actual losses by loans, the new grid has just a much more consistent relationship between what people are paying and what their actual losses are. So it's really important to recognize the old grid was overcharging those very borrowers that you're talking about, and the new grid rectifies that, given, as Mr. DeMarco has talked about, the requirements of the capital regulation that was put in place by the prior director. I also want to separate, which I think is useful in the case of Atlanta, that what I just discussed is not a cross-subsidy, it's just applying an appropriate price for the risk of that group. The cross-subsidy I would describe is in the previous pricing changes that happened before that take, for example, investors. Borrowers buying investment properties have to pay a higher than average profit margin. And that helps with the mission business. It helps lower income borrowers. And I know Atlanta is a city where it's very hard for a low income first-time home buyer to compete with the investors that are there. And so it's appropriate, I think, to think about how the additional charges and profit margin on that population can be used to give first-time home buyers a little more level playing field.
I just saw a news alert came across my phone yesterday, and I opened it up, and it said, guess which U.S. city has the most unaffordable housing cost? And I opened it up, and it is my home city of Atlanta, out of every city in the country. So it is my job to make sure that we look into this more so that more people can access that generational wealth that closes the racial wealth gap. Fannie Mae and Freddie Mac's charter state that they must promote access to mortgage credit throughout the nation by increasing the liquidity of mortgage investments and improving the distribution of investment capital available for residential mortgage financing. Despite these obligations, huge disparities remain in terms of who gets access to a conventional mortgage. For example, in 2021, only 4.7% of Fannie Mae and 4% of Freddie Mac-backed mortgages were taken out by Black home buyers. And I'm sure you already know, Ms. Ratcliffe, research from the Urban Institute suggests more than 1 million mortgages are missing from the U.S. financial market each year due to overly tight credit markets, and a disproportionate percentage of those opportunities are missed by borrowers of color. Ms. Ratcliffe, did the 2008 pricing framework serve to help or hinder credit access for home buyers in communities of color? Oh, is the time up? I can't see the clock. I was going to keep going and
apologies. I would just ask Ms. Ratcliffe if you could respond in writing, and the gentlelady's time has expired. The chair now
Mr. Chairman.
You're welcome. The gentleman from Nebraska, Mr. Flood, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to begin by just expressing some of the frustration that I've heard from my constituents in Nebraska about the Federal Housing Finance Agency's latest mortgage fee assessment. One constituent in Bellevue, Nebraska sent me an email and said to me, quote, "It infuriates me that those that have been responsible with their finances are now being punished to bail out those with lower credit scores," end quote. Nebraskans from Lincoln, Columbus, Omaha, Papillion, Seward, La Vista, and more have been writing into my office saying the same thing. They're absolutely appalled by this change. It is effectively a backdoor tax on the American people. However, I think that most importantly, the American people have a certain natural sense of fairness, a feeling that if you pay your bills on time and improve your credit score, you will be rewarded when you need a loan. This fee assessment is a violation of that basic sense of fairness, and it should be upset. I'm also deeply concerned that this clearly political decision will lead to a future pattern of using the FHFA to make future decisions based on the same principles. If we're abandoning the premise that loan level price adjustment fees should be based upon a loan risk, what's to stop the FHFA from taking things further? Could they use Fannie and Freddie to try and push their favorite social policies or punish individuals they feel are unworthy of well-priced mortgages? Once you open this Pandora's box, I fear what will come next. The FHFA's decision can now be used as a precedent going forward for whatever ill-conceived idea a future director of the agency comes up with. Dr. Rossi, do you have any concerns that this change in LLPA will set a precedent for further politically motivated interventions for fees for mortgages?
I'll first start by saying I completely agree with your constituent there. First of all, and it goes back to the fact that I've said before that we have to separate these missions that the GSEs have from each other. And I think we've heard Mr. DeMarco say the same thing. Several have been saying the same thing today, which is we have to separate those from each other because it creates and it invites this kind of discussion. And I don't think it has to happen that way. We can actually meet safety and soundness for both GSEs while at the same time doing everything we can to be fair to our fellow citizens. And I think that comes from being able to take a closer look at how we kind of, I would say, jettison the LLPAs altogether, replace it, build it back into a risk-based fashion within the ongoing G fee. And if you want to do something outside of that in terms of affordable housing, make it clear, make it transparent to the American public what you're doing.
Do you have any concern that further changes, Dr. Rossi, to weaken the integrity of the credit pricing could expose the GSEs to greater credit risk? I mean, you alluded to that, but.
Yeah, so there's always that possibility, and again, it comes back to again, Mr. DeMarco talked about this in terms of the enterprise capital framework. We're taking a much closer look at the GSEs in terms of their risk-based pricing than ever before, particularly around these stress events. So again, it does when I saw the grids when they came out, it first caught me off guard a little bit because, as I said earlier, I want to make sure that what we do from differentiating affordable housing policy is not muddied up with how we actually are doing credit pricing. When we do credit pricing, it's for risk. It's for the safety and soundness of those entities. That's where I'm at.
I come back to this idea that it's just basic fairness for Americans, that if you pay your bills on time, you earn a good credit score. And there are many folks in this country that have done that. They should be rewarded for the risk that they pose, for the lower amount of risk that they pose to the borrower, or the financial institution. I would say this pricing change is a flat-out disaster. I look forward to working with my colleagues, including Chairman Davidson, to push legislation that will rescind these changes. The people of Nebraska, along with people across the country that believe in basic fairness, are depending on us to serve as a check on the Biden administration on this matter specifically. I thank you all for your testimony. I yield back.
The gentleman yields. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you, Mr. Chair. Thank you all so much for being here. Michigan, especially in Wayne County, really didn't recover fully from the last recession. You're all nodding your heads. You probably saw, some of the things that we've seen is obviously private equity firms coming in and just swallowing up, not only from mortgage foreclosures, tax foreclosures. And so we got hit pretty hard and haven't truly been able to recover. We also lost more black home ownership than any other state in the country. So one of the things on this committee, I've been looking at some structural issues, right? And Mr. President Parcell, one of the things that I've been really trying to get the administration, the previous one and current one, is to look at small dollar mortgages, because the majority of homes in my district are less than $100,000, and it's not profitable for some of the institutions. And so what happens is they become rental properties for those investors that come in and swallow them up. And I know there was a report recently. There's not a lot of recommendations, just identifying the problems we already know. What do you think, President Parcell, we could do as a federal government, and maybe it's a public-private partnership, I don't know, in trying to help our families, working class families, that if they could access those homes that are $70,000, $80,000, they'd probably be paying less towards housing costs than again, continuing to rent.
Thank you, Congresswoman. I appreciate that. For clear, we represent 1.5 million in every zip code, and yours is one of them. We think that a reduction of all the fees would be helpful. We also think that if you can make some kind of an incentive for that investor to sell back to a homeowner, a first-time homeowner, what kind of a tax break that they may be able to have. Also to work with some of the accessory dwelling units, the ADUs, to that maybe they can rent out the part of their basement to help subsidize that payment to start building wealth. It is the number one.
They're not going to get, who's going to give them the loan?
They need to be able to get a loan for
That's what I'm saying. Who's going to give them a loan for $70,000, $80,000? Miss Ratcliffe, I'm really trying to start. These are, by the way, we're always going to have frontline workers as our neighbors. You guys know that. There will always be those in the hospitality, those in the ag community, those that will not be in that income class that they're going to be able to afford a $150,000 or more house. Ms. Ratcliffe?
Yeah, I think the fundamental challenge we have there is that the cost to make a new mortgage are the same no matter how big the mortgage is. And so when it comes down to limited resources and loan officers making decisions about where they're going to spend their time, it's very hard for them for economically to work.
But would it be incentives to say, hey, if it's this amount of money, then we should be
FHA recently had a request for information on low balance mortgages, and some of the recommendations are in fact to subsidize that, and I think I would also add another tool that might be useful in a case like this is better financing for purchase rehab, because a lot of the homes today are older. Investors have an advantage because they can come right in with deep pockets and fix them up, and the buyer can only borrow based on the as-is value and can't get credit for the, so we know this whole story.
Ms. Ratcliffe, you're right on. I think it's really important to know that some of those homes are never move-in ready, especially at that cost. They do need rehab. Dr. Rossi, did you have something to say?
No, I was nodding my head vehemently in favor of what she said about FHA. I think that's a good response.
So the other important thing that I've been working on is our credit scoring system. It is broken. Do you all agree that it needs some sort of overhaul? Let me tell you why. For instance, medical debt is treated the same way. I know some are not actually looking at medical debt now, I understand, but it really does hold back some of my folks because something they did at 18 is on their credit report for 7 years. I have a bill that reduced it to 4 years, which I think is a great bipartisan bill. Economists say 4 years is a better indicator anyways than 7 years. Can any of you talk about that?
Well, medical is being adjusted in mortgage underwriting, but the credit score issue, Congresswoman, is a serious one, and we've been spending this whole hearing talking about FHFA, so here's another place where FHFA is playing, you know, a significant role, right? I mean, they've come out with a new framework in which we're going to update the credit score model that's used. There's going to be 2 different credit score models used. But the thing I would caution about that holds the potential for, you know, improved accuracy and so forth. But that is a very hard thing to implement, given that credit scores appear in so many different models and uses in housing. So having a timeline to get this done right is going to be really important to it being implemented
I had so many other
successfully.
questions for you, but I ran out of time. Thank you, though. I appreciate it.
I'd like to thank our witnesses and my colleagues for testimony and questions today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.